access the secure terminal and initialize the primary block explorer, because the cryptographic telemetry we are intercepting today is unprecedented. Welcome back to the channel, where we bypass the mainstream media narratives and dive directly into the raw on-chain forensics. Today's decrypted file is titled "Ripple just dropped a major update. XRP holders react fast." And the institutional data packets we have unraveled over the last 48 hours represent a fundamental paradigm shift in the United States regulatory infrastructure. While retail sentiment algorithms are flashing extreme fear due to the current price suppression at the 143 to 147 levels, our network nodes are detecting a massive geopolitical alignment. Ripple's chief executive officer Brad Garlinghouse just deployed a major update, officially projecting a staggering 90% statistical probability that the Digital Asset Market Clarity Act will be passed into federal law by the end of April. But this is not merely a speculative prediction, it is backed by concrete structural moves. We have verified that Garlinghouse has been officially appointed to the Commodity Futures Trading Commission's Innovation Advisory Committee. The very same technology firm that was previously targeted by federal enforcement is now actively embedded within the federal regulatory apparatus, actively writing the operational rulebook for the global digital economy. When this data initially propagated across the trading networks, high-frequency algorithmic bots immediately processed the bullish catalyst, triggering a violent 8% price spike to the 166 resistance zone. However, within 24 hours, the market makers executed a severe liquidation protocol. They slammed the price back down to the mid $1 range to systematically eradicate over-leveraged retail traders and absorb their liquidated assets at a significant wholesale discount. This is a classic liquidity flush engineered by elite quantitative trading desks. They utilize the sudden influx of positive news to lure in inexperienced retail capital with extreme leverage, only to completely reverse the momentum and trigger cascading stop-loss orders. You are witnessing a mathematically precise transfer of wealth from the impatient retail sector directly into institutional cold storage vaults. If you panic sell your physical holdings during these engineered volatility spikes, you are willingly participating in your own financial execution. The fundamental regulatory framework of the United States is currently being hardwired to accommodate the XRP ledger, and the algorithms are doing everything in their power to shake you out before the legal floodgates officially open. You must learn to read the underlying data matrices, ignore the psychological warfare being waged on the graphical candlestick charts, and strictly align your portfolio parameters with the accumulating whales. The on-chain evidence is mathematically undeniable. Let us initiate the secondary diagnostic protocol and examine the exact capital flows flooding the US ETF infrastructure. When you analyze API data from major fund managers like Bitwise, Canary, and Franklin Templeton, a statistical anomaly becomes glaringly obvious. Despite the broader cryptocurrency market experiencing a macroeconomic contraction in early 2026, the US spot XRP ETFs have consistently recorded positive net inflows. They have effectively sequestered over $1 billion in physical assets. How is the spot price hovering at 143 while over $1 billion in institutional buy pressure enters the system? The answer lies in the complex mechanics of over-the-counter or OTC settlement layers. The ETF issuers are not placing market buy orders on public retail exchanges like Coinbase, which would instantly spike the price. Instead, they utilize dark pools and private liquidity providers to source their physical XRP. These specialized liquidity providers are simultaneously shorting the public futures markets to perfectly hedge their exposure, essentially creating a fake, impenetrable ceiling on the retail price. This is a highly sophisticated financial operation explicitly designed to prevent retail investors from successfully riding the institutional wave. If we deploy our tracking algorithms on the blockchain addresses associated with these OTC desks, we observe a continuous unidirectional flow of tokens permanently leaving the circulating supply and entering deep cold storage. They are mathematically locking up the float. This is the underlying structural manipulation that is rocking the US market beneath the surface. Ripple's recent infrastructure filings have provided these legacy financial institutions with the ultimate regulatory green light to deploy vast amounts of capital without the lingering fear of federal litigation. The traditional financial sector has evaluated the network architecture and concluded that the XRP ledger is the most efficient settlement rail in global existence. The retail market is hopelessly distracted by superficial, short-term price action, oblivious to the fact that the underlying network is being aggressively colonized by Wall Street Street conglomerates. The cryptographic metrics are screaming at us in real time. Every single time the retail price dips, the institutional wallet balances drastically increase. They are aggressively capitalizing on your lack of on-chain visibility. If you want to survive this brutal accumulation phase, you must stop trading based on human emotion and start investing based on cryptographic reality. The data clearly shows a massive supply shock is forming in the background. When the OTC desks inevitably run dry of cheap XRP, they will be forced to route their massive buy orders directly through the public exchanges. When that threshold is crossed, the algorithmic suppression will shatter and the price will violently re-rate to match the actual physical demand matrix. Do not let them blind you. We must now shift our analytical focus to the core utility engine driving this entire network expansion, because Ripple just dropped a massive structural update that fundamentally alters the institutional value proposition of the ledger. If you run a query on the latest XRP ledger commits, you will discover a monumental integration protocol that was just deployed. Ripple has officially rolled out an enterprise-grade upgrade that plugs Securus's hardware security modules and Figment's staking infrastructure directly into their institutional custody workflows. Retail analysts are misinterpreting the sheer magnitude of this data. This is not a standard software patch. This is the cryptographic bridge that Wall Street has been demanding. By integrating these advanced security modules, regulated legacy institutions can now manage their cryptographic keys with absolute compliance baked directly into the protocol architecture. Furthermore, the integration of Figment's infrastructure allows these massive asset managers to actively earn proof-of-stake rewards across multiple networks while utilizing Ripple's unified custody interface. This effectively transforms Ripple from a cross-border payment network into a comprehensive omni-chain digital asset command center. When a legacy bank utilizes Ripple's newly expanded custody solutions, they are simultaneously hardwiring their backend servers directly into the XRP ledger's routing protocol. The on-chain telemetry reveals an even more explosive metric, the real-world asset, or RWA, tokenization sector. As of late February 2026, the verifiable on-chain presence of tokenized assets on the XRPL has aggressively surpassed the $354 million threshold. We are tracking global investment giants actively developing trading and lending infrastructure around tokenized money market funds natively issued on the XRP ledger. The network operates as a frictionless digital toll road. In order to mint these tokenized treasury assets, transfer them between vaults, or utilize them in automated market maker pools, institutions are strictly mandated by the protocol to consume XRP as transactional gas. As Ripple successfully onboards Fortune 500 companies into this ecosystem, the baseline transaction volume goes absolutely parabolic. This creates an unstoppable, automated, non-speculative demand vector for the XRP token. It is a purely mechanical function of the network. We are not relying on social media hype. We are relying on immutable code executing millions of financial contracts per second. The algorithms projecting the future value of this network are heavily factoring in this massive surge in utility volume. As the burn rate of the token accelerates due to RWA and RLUSD usage, the total circulating supply becomes demonstrably scarcer. It is basic cryptographic economics. The network is aggressively absorbing the entire global liquidity layer. Let us initialize the final predictive models and establish a concrete, data-driven execution protocol for your portfolio. We have empirically verified the institutional accumulation, the algorithmic price suppression at 143, and the fundamental utility generated by Ripple's new hardware custody integrations and RWA tokenization metrics. What does the advanced predictive analytics software project for the future valuation of this asset? Major institutional quantitative models, specifically those recently updated by Standard Chartered Bank, have calculated a macro-adjusted base target of $8.00 for the end of the 2026 fiscal year. Retail investors erroneously view the current suppressed price action as a failure, failing to process the macroeconomic variables of the impending Digital Asset Market Clarity Act. Advanced projection models recently simulated the scenario where the Clarity Act passes by April and Ripple achieves full integration with Tier 1 US domestic payment rails. The mathematical output of that simulation projects a staggering valuation range of $5.00 to over $100 per token, a mathematical jump from the current 143 suppression zone to even the lowest boundary of that projection represents a geometric return on capital that eclipses traditional equity assets. You must strictly execute a disciplined exit strategy based on these statistical probabilities. Removing all human emotion from the equation, I utilize a a rigid automated thirds protocol. When the network price officially reclaims the historical all-time high parameter of 3.84, I will automatically liquidate exactly 33.3% of my holdings. This executes a full recovery of the initial capital deployment and secures an undeniable mathematical profit, eliminating all portfolio risk. The secondary tranche is programmed to ride toward the 8.00 to $10 institutional target zone. This is the primary wealth generation vector. The final tertiary portion is locked securely in cold storage for the 2030 long-term macro play, anticipating XRP's integration as the undisputed global settlement layer. You must absolutely secure your private keys offline immediately. As the network value increases, cyber threat vectors will multiply exponentially. We are currently tracking a massive surge in sophisticated cryptographic phishing campaigns and malicious smart contracts designed to drain retail wallets. Upgrade your security infrastructure utilizing hardware authentication protocols. The US market has been fundamentally rocked by Ripple's strategic deployment, and the data clearly proves that the accumulation phase is nearing its mathematical conclusion. Trust the blockchain, ignore the manipulated graphical charts, execute your strategy flawlessly, and I will see you at the absolute top of this cryptographic cycle.